Okay, hi everyone. This is going to be the lecture for chapter 6. We're looking here at variable versus absorption costing, okay? Okay, so with this, right, first let's talk about some concepts here. Right, so these are two different ways that you can prepare and present an income statement. Right, now there's going to be similarities between them, and there's going to be differences. Right, so the idea with it is variable and absorption income statements, they're similar insofar that they both have period costs and product costs. Right, so in other words, certain costs will be capitalized and put in inventory. Right, these are sometimes called inventoriable costs. Under both systems, you'll do that. Likewise, under both systems, you will have period costs, right? You'll expense those in the period you incur. All right, so they're similar in that regard. However, right, which costs they decide to make period versus product, that's where they're gonna differ, right? We'll talk about that, kind of some foreshadowing here. It has to do with fixed manufacturing overhead. Likewise, right, if we're looking at it, variable costing income statements, they're going to follow the contribution format income statement, right? So we've seen the contribution format before, right? You're going to have your sales minus your variable costs, gives you your contribution margin. Afterwards, you're going to back out your fixed expenses. Okay, so it separates and breaks out your variable and fixed costs under variable costing. Now, in distinction, right, under absorption costing, we're not really looking or going to break it out by variable or fixed. In fact, it's just going to be very similar to a traditional GAAP external income statement. That is to say, you'll have your sales minus your cost of goods sold, gives you your gross margin, back out your other operating and non-operating expenses, gets you to your net income. And as I have down here at the bottom, right, so again, we're looking at two different income statement formats. Where they really differ and where we'll see this is going to be how they treat fixed manufacturing overhead, right? In short, right, under absorption costing, all of the costs are going to be absorbed into inventory. All of the the traditional product costs, direct material, direct labor, manufacturing overhead, and that manufacturing overhead, that'll be variable or fixed. In distinction, right, under variable costing, how they treat fixed manufacturing overhead, instead of capitalizing it or putting it on the balance sheet as part of inventory, they're going to expense it in the period incurred. Okay, so let's look at some more items here. All right, and a lot of this is going to be what I just said, but hey, the more you hear it, the better. Right, so with variable costing, when they're looking at manufacturing costs, right, they're going to say only those manufacturing costs that vary with output, namely your direct materials, your direct labor, and your variable manufacturing overhead, those are going to be the only ones that are product costs. Debit inventory, right? Debit WIP in that case. Fixed manufacturing overhead, as we just discussed, that's going to be a period cost. Expense it in the period it incurs, right? It happens, expense it. Now, sometimes variable costing is called direct costing or marginal costing. And we will see as we go through this lecture, right, that it's most commonly used for internal reporting purposes. The idea is with this, because we separate our variable from our fixed costs, it really it lends itself better from an internal analysis to aid in decision making, maybe applying things like cost volume profit analysis. It's a little bit easier to do that in this format. Now, in distinction, right, absorption costing, this is going to be pretty much the idea of what you've seen with an income statement before you entered this class. right? It's that traditional GAAP external reporting. All of the costs, right? All of our manufacturing costs, our direct materials, our direct labor, our variable manufacturing overhead, and our fixed manufacturing overhead, those are going to be capitalized in inventory, right? All of them, right? It's absorption, are going to be in there. Now, in this way, right, fixed manufacturing overhead is going to be a product cost. You only take the expense for this later when you sell the item, right? So the idea under absorption costing, just like how we've learned with any inventory, tee it up, tee it up, tee it up. When you sell it, take the expense, debit cost of goods sold, credit inventory. The idea with it is that fixed manufacturing overhead, that's part of every time you tee it up, build it up, the inventory level, it's being capitalized and put on the balance sheet, right? You only expense that fixed manufacturing overhead later on, right? When you kick the can and you take the expense, cost of goods sold upon sale. In distinction, right, variable costing, while they also tee it up, build up inventory, build it up, it's not growing or getting as big at the same rate because we're not including all of the costs there. In other words, fixed manufacturing overhead, we would take the expense in the period, right? We don't wait to take it later on when we sell the product. Now, there's good and bad with each of these. It doesn't necessarily mean that one presentation is better than another. It really would come down to what purpose are you looking at this for, right? Like external investors, they would more likely prefer seeing an absorption costing income statement. It's kind of traditionally what they expect to see. It's required by GAAP. It's going to show your inventory levels. There we're not going to maybe have as many expenses, right? So it's a little bit more of like a conservative presentation because we're not necessarily expensing that fixed manufacturing overhead. Whereas in distinction, if you were an internal user, right, you were a manager like in a business and you were looking at your different product lines, in that case, right, you'd be more likely to use a variable costing system. It could really show you hey, what costs are in our control, what costs are not in our control, what costs vary between the items versus which ones are fixed, right? We have that contribution margin that really gives us kind of a good landing point for where to conduct an analysis. Now, the idea with this, right, whether you use variable costing or absorption costing, one item is going to be treated the same in both. That is to say, you're selling general and administrative expenses. Those are going to be period costs under both systems, regardless if it's a fixed or variable cost. So in other words, both systems, fixed and variable, selling general and administrative, is a period cost. Expense it in the period incurred. Right, so the idea with this is you may think something like, well, hey, variable selling expense, shouldn't that be part of, variable costing, our variable expenses? Yes, it is a variable expense, but we're not capitalizing it as part of our inventory. Instead, we're expensing it in the period it happens. Same with fixed expenses, right? Fixed selling, general, administrative. Both systems expense it in the period it incurs. All right, so here is a little graph, showing you the items, right? So we've seen a similar item to this, right? We're going to have our raw materials, our direct labor, our variable manufacturing overhead, and our fixed manufacturing overhead. On our balance sheet, right, we're going to have our raw materials. Once we put those into production, right, we put them on the conveyor belt, we start using them, they become part of our WIP. Right, now our WIP is going to be comprised, in this case, under absorption costing, traditional, external, GAAP reporting. It's going to be our direct labor, It's going to be comprised of our direct materials up here, and then both manufacturing overheads, variable and fixed, right? Under absorption, it would go into inventory. You capitalize it. Once it flows through, right, it's like tee it up, tee it up, tee it up, flows through all those items. When you sell it, take the expense, cost of goods sold. Similar framework, right, for variable costing. The idea with this is we're going to include our direct materials, our direct labor, and our variable manufacturing overhead. Those do go on the balance sheet as part of inventory. Take the expense for them when you sell it. However, this fixed manufacturing overhead down here, right, that's going to be expensed in the period, right? We don't put it on the balance sheet. We don't capitalize it. And then down here, right, your SG&A, your non-manufacturing costs, under both systems, absorption and variable costing, you expense it in the period incurred. Right, so we're going to look at a few examples here. This chapter might be a little bit better illustrated or easier to understand through problems because there's a lot of pictures and stuff here, but we will work our way through this. So let's look at an example here. We are using, let's say, actual costing instead of normal costing. So what that means is instead of looking at like our estimated total manufacturing overhead and then applying it by virtue of that predetermined overhead rate, we're going to just assume that we actually know our manufacturing overhead, both our variable manufacturing overhead and our fixed manufacturing overhead. For purposes of this example, just assume we know actually what it was. Likewise, we're going to be using the actual number of units produced, as our allocation base. So for assigning any manufacturing overhead. And the idea here also that we're going to assume is that the variable manufacturing costs per unit and our total fixed manufacturing overhead are going to remain constant. And let's just say there's no beginning or ending inventory. All right, so having stated these assumptions, right, how we have it, let's look at the difference here for how this might kind of shake out between a variable costing income statement and an absorption costing income statement. Now we're looking here at Weber Light Aircraft. That's the name there. Looks like they produce recreational aircrafts. Now, data concerning their operations is going to be shown below, right? It looks like we have 3 months, January, February, March. Then they're going to be giving us the idea here of the selling price per aircraft, our direct materials, our direct labor, our variable and fixed manufacturing overhead, and then we have some SG&A down here. Okay? So based on this general information, right, let's first prepare a variable costing income statement. Afterwards, right, we'll look at an absorption costing income statement. Okay, so to prepare the variable costing income statement, that is to say where we break out our variable costs from our fixed, right, we're going to land in the middle there at the contribution margin. First thing we got to do here is compute the unit product cost. What does producing one of these aircrafts cost us? Right, so under variable costing, right, the idea here is we're going to have our direct materials, our direct labor, and our variable manufacturing overhead. In other words, we're not including our fixed manufacturing overhead. So, right, it's going to be like 19, 5, and 1 for those items. We're looking at 25,000 there, right? And the idea here is, as it says here, right, because each month's unit product cost is 25,000 per aircraft, the variable costing, cost of goods sold, for all 3 months will be computed as follows. Right, so in other words, we figure out the cost, that's kind of step one, and you look at how many units you sold in the month. Right, so if we go back here, right, it looks like we sold 5, right, so 25 a pop, 115. That's going to be our cost of goods sold. right? An expense we take on the income statement. And it's our cost of goods sold because it's the cost of the goods we sold, right? One aircraft, the cost of that, using our constraints, right? Our direct material, our direct labor, and just our variable manufacturing overhead costs 25, right? So what we're doing here is we tee it up. Whenever we sell it, right, we take the expense as cost of goods sold. And the amount that we put in there, right, comes right from up here. We determine the cost of that good we sold. Oops, sorry. All right, next thing it says down here is the company's total SG&A would be derived as follows, right? So the idea here is they're going to include both their variable and fixed, right? Even though this is a variable costing income statement, same treatment under both, right? Variable and fixed are expensed in there. So it looks like each month there was 10, 20, right? Again, they're getting this information right from over here, right? 10 and 20 each month. And then in March, it looks like it must have been 50 and 20, okay? Right, so the 50 and 20, how do they get that? Right, the variable is 10, right? It looks like in March they had 5, right? So the variable selling, it's a function of how many they sold, 5. And then the other months, it's 10 and 10, right? The fixed is going to be fixed each month, 20 grand fixed. All right, next up, right, putting it all together, they would kind of unpack this in a variable costing income statement as follows, right? So they're going to have the sales minus the variable expenses, right? Variable cost of goods sold, SG&A, lands us at our contribution margin. Right, from there we back out our fixed expenses, right? That will get us at our net operating income. So main thing, just to summarize this very quickly, variable costing follows the contribution margin format. Sales minus variable costs get you contribution margin, minus fixed costs get you your net operating income. Now, the idea here, the main difference that I've kind of highlighted is variable costing. It's going to expense the fixed in the period incurred. In distinction, under absorption costing, fixed is only expensed later when we sell the item. All right, so looking here, right, from this, it says a simple method for understanding how it computed the variable costing net operating for each month income is to focus on the contribution margin per aircraft sold. Okay, so what they're doing here is they're taking, hey, we sell each aircraft for 100 grand, right? We get that right from over here. We then have to back out, our variable expenses to it, on a per unit basis here. We're looking at 65 grand. Okay, and then showing it here, right, each month, it looks like we sold 115. Multiply that times the contribution margin up here, right, we get that 65. You can see it across. Back out our fixed expenses, we'll get the net operating income. Right, same idea over here, right? This is like the whole thing spelled out. This is sort of like a shortened version to get you to the same ending. Right, it's kind of like spelling a word that you can put a contraction to. So let me think of like a quick word that has a contraction. Right, so like cannot. Right, this would be like cannot, like you did the whole word. This is like just doing can't. Right, you make it a contraction. It's a little bit shorter, get you to the same spot there. Right, now the one thing they're saying down here is, notice in January and February, right, that we're going to have the same net operating loss. The reason for this, right, is going to be because it's going to be, getting tongue-tied. It says this occurs because one aircraft was sold in each month, and as previously mentioned, the selling price per aircraft, the variable cost per aircraft, and the total fixed monthly expenses remain constant. So in other words, if you sell one each month and you have constant other expenses, it's going to land you at the same spot. All right, let's look here at the absorption costing income statement. Right, so we said that this is more like GAAP. It's traditionally used for external reporting. And with this, right, we're going to, first here, it says the first step is going to be determine the company's unit product cost. So what we're going to do here is we're going to take, look at our direct materials for each month, direct labor for each month, our variable manufacturing overhead per each month. But here's the deal, right? This is where it kind of bifurcates and gets a little bit separate. In this case, right, first off, when we're using absorption costing, we include in the unit cost the fixed manufacturing overhead. Under variable costing, we did not. So that's the first difference. Likewise, when we include it, right, we have to spread this out, right, over the number of units produced in there, right, because they're just giving you the total amount, but in here, right, we're trying to find it on a per unit cost. Okay, so it looks like in January and February, in January, we had 1 unit that was produced, right, so we go back to the data here. We produced 1, then we did 2, then we did 4. So in other words, each month we got to spread out, let's find it here, this 70,000. It's a function of, on a per unit basis, how many we produced. Right, so 70 divided by 1, divided by 2, divided by 4, that will get you 70, 35, and 17.5. Right, so the idea here is, again, you're going to add up your direct materials, your direct labor, your variable manufacturing overhead, your fixed on a per unit basis, which means you have to kind of take that total fixed manufacturing overhead each month, divide it by the number of units produced. That will give you your unit product costs. Now, this is going to be different each month from one another, right? When we looked at the variable costing, we had the same fixed expenses. It was a flat 25,000. This is different, right? It's going to be different. We had 95 in month 1, 60, and 42.5. Right, so the next thing, right, we're going to show here is our net operating income. So this is a little bit simpler, right? All we're doing is taking our sales minus our cost of goods sold, gets us our gross margin. The numbers we put in this cost of goods sold, right? We're going to have to look at, first off, how many we sold each month. So let's go back, right? So it looks like we sold 115. All right, so 1, 1. Oh, let's see here. Oh, okay. Yep, okay, so it's 115. Here's where you have to be a little bit careful on this if we go back, right? So it's going to be, one of the things you have to remember here is that under our assumptions, we had no beginning and ending inventory when we started here. So in month 1, we produced 1 and we sold 1 that cost us 95, okay? In month 2, we produced 1 and then we sold 1 that cost us 60. Now in month 3, we sold 5, right? But if we go and we look, right, so I'm sorry here, in month 2, we produced 2. So we produced 1, sold 1. Produced 2, sold 1. Now in month 5, we produced 4 and we sold 5. Now of that 5, right, 1 comes from here and the remaining 4 come from month 3. Right, so the idea with this is we then have to do 1 that comes from month 2 cost of 60,000, the remaining 4 that comes from month 3 cost of 42.5. So you kind of have to unpack that a little bit carefully there. And you can rewatch that, if you want to look at it, but we'll have our sales minus our cost of goods sold, gets us our gross margin. back out our SG&A, right, under both cases. That's going to be the setup there. You expense it. Will get us to our net operating income or loss. All right, so this is just showing you, a comparison of the two income statements, right? You can see over here we have the variable costing, sales minus variable, get you contribution, minus fixed, get you net operating, versus absorption, sales minus cost of goods sold, get you gross margin, back out SG&A, get you operating income. And the idea with these is, with the variable income statement, right, which uses the contribution format, they have costs, in how they're designing this, unpacking it, laying out. They look at, hey, how do these costs behave? If it's a variable cost, including our variable manufacturing overhead and variable selling, we'll put it in the variable area. If it's a fixed cost, right, where we're going to include our fixed manufacturing overhead in that case, as well as our fixed selling and administrative, we're going to include that in that area. Under our absorption, right, we're not really looking, we don't care if it's fixed or variable. We look at it by function or type, right? Is this a product cost up here, right, that we put into our inventory? We take the expense, we'll include our direct materials, our direct labor, all of our manufacturing overhead. Don't care if it's direct, indirect, variable, fixed there. And then the idea is, with the SG&A, again down here, we take it for the full amount, right? For 30, 30, 70, we don't care if it's variable or fixed, right? So just as like a quick comparison with the SG&A, over here we're taking a 30 expense in month 1. Over here, right, they're taking 10 plus 20. They're still taking 30, but they're bifurcating it, right? They're breaking it out a little bit further to show the difference. Now, if we're looking at like the operating income between them, right? In the first month, we're going to be the same. However, where we start to differ is going to be February and March. And really the reason for this, to explain these differences, we'll see in the problems, it has to deal with the fixed manufacturing overhead. In this system over here, we expense it in the period. Over here, we wait until we sell it to take the expense, right? So that shows the difference between them there from that. This will eventually work itself out, right? The idea with this is we're just kind of shuffling the deck a little bit for how we present it, right? If we have negative 25 here and 10 there, right? That difference between those two, that 35,000, is going to reverse out by the end of March, right? So the idea here to get from negative 25 to 10, there's a 35,000 difference in year 2. But hey, it reverses out, in month 2. It reverses out in month 3. There's a $35,000 difference. Now, looking at that, right, and kind of analyzing the setup and looking at the specific numbers, we can come to some conclusions here. Right, so generally when units produced in a single month or period are greater than our units sold, that is to say our inventory increases, right? So just a simple way, right? If you make 100 watches, you only sell 60 of them, right? At the end of the day, your inventory has gone up by 40, right? You made more than you sold. Your inventory increases. If that's the case, right, then net operating income is going to be higher under absorption costing than under variable costing. The explanation for that, right, it's going to be how you treat that fixed manufacturing overhead. In other words, in this situation, the fixed manufacturing overhead, some of that period, it's going to be deferred under absorption, right? You kick the can on it until later on when you sell it. Likewise, whenever you have the reverse situation, when your units produced are less than your units sold, that is to say your inventory decreases, then your net operating income is going to be lower under absorption costing than under variable costing. And the idea with this is some of those fixed manufacturing overhead costs, they're going to be released from inventory under absorption costing. Right, so this is just showing it, right? If our units produced in a single period equal our units sold, no change in inventory, absorption will equal variable costing. If, however, our units produced are greater than our units sold, our inventory increases, absorption will be greater than variable. Third, if we have the reverse, right, our units produced are less than our units sold, our inventory went down, absorption will be less than variable costing. Right, so this is just drawing some conclusions, some general rules. In short, right, because one system expenses fixed manufacturing overhead in the period, whereas another system capitalizes it, right? If that's the general rule between them, if you have changes in inventory and you apply that rule, you then will have certain outcomes. Your absorption costing income statement, your income there could be greater than or less than, right? So these are just drawing kind of like inferences or other logical conclusions. Because of those baseline rules, those baseline differences, there will be further items or conclusions that we can reach based off that. It's like, if this is true, if X is true, these differences are true, then Y has to be true, right? So if your inventory increases, Y, certain outcome. If it decreases, Z, right? Another outcome. Just applying logic there to come to some general conclusions. The next part here, right, we're going to look and see, hey, how do you reconcile the difference between these, right? So if you remember taking financial accounting, maybe you did a bank reconciliation. And in that, to just kind of give like a 2-second overview of it, right, you'd have your ending balance on your books versus the ending balance on the bank statement for cash. And you try to explain away, right, why they're different to each other. You reconcile, right? Make it, kind of jive. Have it make sense even though they're different. Same idea here with a reconciliation, right? How can we go and show the differences between our variable costing net operating income versus our absorption costing net operating income? And again, the main difference between that, right, is going to be the fixed manufacturing overhead. So how you can, look at this, right, as we have here, variable costing and absorption costing net operating income can be reconciled by determining how much fixed manufacturing overhead was deferred in or released from inventory during the period. So the idea here is, right, if we look at our fixed manufacturing overhead deferred in or released from, it looks like the fixed manufacturing overhead and ending inventory was 0, 35, 0. You're going to back out any fixed manufacturing overhead in beginning, 0, 0, 35. That will show you the fixed manufacturing overhead that was deferred in, if it was 35,000, or released from, negative there, 35,000. In short, right, if you want to express this in an equation, your manufacturing overhead that was deferred in or released from, you're going to take your fixed from your ending minus your fixed from the beginning, right? And once you, have these items, we could do a reconciliation, right? So it's kind of like step 1 and then step 2 here, right? 0, 35, negative 35, carry that over, 0, 35, negative 35. In other words, you take your variable costing net operating income, you add to that any positives from step 1, that is to say any fixed manufacturing overhead that was deferred under absorption costing. So 25, plus 0, 25, negative 25, plus 35 gets you 10, 235, minus 35 gets you 200. Right, you go from your variable to the adjustment till that gets you to your absorption, right? This is how we would reconcile the differences between them. Go from one system to the other. All right, a few kind of other points here, right? If we were looking at the pros and cons of each of these systems, with variable costing, it's going to have certain advantages, right? In other words, first off, conducting cost volume profit analysis, if you remember from a chapter or two ago, that's going to be easier to do under variable costing than absorption costing. The reason being is we already have our items broken out for how we want them, right? We're going to have our contribution margin there. We have our fixed expenses broken out from our variable expenses. So just by way of example, if we look at this, right, assume we have a target profit of $235K a month, right? So that's like a form of cost volume profit analysis. Let's say we have total fixed expenses of $90,000 per month, right? So based on the information we had before, right, in order to achieve this target profit, we would need $500,000 in sales, right? This is just showing it over here, right? If you want 235 as your target profit, plug that in there, add your fixed expenses, divide it by the contribution margin ratio. You better sell $500,000 to get the target profit you want. Okay. Now the idea with this is cost volume profit is going to be more accurate for variable costing versus absorption costing. So in March, for example, if we have 500K in sales, so if we go back here to our variable costing income statement, let's find that guy, right? In March, we have 500K. Oh, and then check it out, right? We get that target profit. Right, it makes sense, right? What we did in the target profit analysis ties out under variable costing. The framework and assumptions of target profit analysis holds true. However, right, here's the problem. Over here on absorption, we have 500,000 in sales, but we don't get to that 235, right? It doesn't tie out to the target profit number. Right, and that's what this is showing here, right? Cost volume profit, it's not going to work as well under absorption costing. The kind of assumptions and the frameworks made in that aren't going to jive with the presentation on absorption costing. Another item here, right, if we were looking at them, variable costing, the income statement, that's going to be a little bit easier if you're an internal person to pick up and understand, right? As our sales go up, our income's going to go up. Basically, the units produced aren't going to affect our operating income. Absorption costing is a little bit more difficult to pick up and understand. If we looked at our net operating income, for example, January and February, the idea here is it will have changed, right? So if we go over to absorption costing, let's look at this guy here. Right, so January to February, we went, 100,000 in sales. We went from a loss to positive, right? Like, how did that happen? Well, the explanation for it, right, is that, can come from various items there. One of them being, did our inventory increase or decrease? But on the face of it, right, the four corners of the document, it's not really as clear, right? If we were trying to make decisions on that, we would say, just looking at it, we have the same sales in each month, but our income, really differs. Why is that the case? Right? So because all of these reasons, variable costing income statements, they're going to be better suited for decision-making purposes. Right? We can use it for cost volume profit. It breaks things out, shows us it nice and clearly there. Absorption costing, hey, that's helpful. We use it for GAAP, not as good as variable costing. All right, a few other items here, right? So let's look now at how to use the contribution approach to make income statements for business segments. Right, so a segment may be like an operating division or a line within the company, like different segments of the business. A few kind of terms we have to define here up front, right? We have traceable fixed costs, common fixed costs, and the segment margin. So a traceable fixed cost, this is going to be a fixed cost that is incurred because of the existence of the segment. That is to say, right, but for the segment existing, we would not have incurred this fixed cost, right? So the idea of a manager's salary of a segment. So you have like a segment that sells t-shirts or something, right? But for that segment existing, we wouldn't have to pay that manager's salary, right? The only reason that it exists, the manager's salary, is because we have that segment, right? So that's a traceable fixed cost to the segment. In distinction, right, if we have a common fixed cost, the idea with this is a fixed cost that supports the operations of more than one segment, but it's not traceable to any one segment, right? So maybe the salary of the CEO, like maybe we have 5 segments, and we have a CEO who oversees everything, right? That supports multiple segments, but it's not directly traceable to one of the segments. Now, the idea with common fixed costs, one thing we have to be aware of, that traceable fixed costs to one department, so for example, Department A, may be fixed costs to another department or segment, Department B. Right? So for example, a landing fee at an airport, this would be a traceable fixed cost if you were looking at the plane itself. Right? However, you could further break this cost down, right? The landing fee, if you were to then subdivide the people on the plane between first class and economy as like sub-segments of the plane, it would be a common fixed cost, right? So again, it's kind of like, what's the vantage point you're looking at? What's the cost object? What's the segment you're looking at? Well, if the segment is the airplane, it's a traceable fixed cost. If the segment is a seating aisle or a seating status on the airplane, well, there's multiple of them, it would be a common fixed cost. So don't make the mistake of thinking that a single cost could only fall into one bucket. It normally does, but again, it's a function of what you're looking at. Then you have your segment margin, right? So your segment contribution, this is going to be your segment contribution margin less traceable fixed costs of the segment. We're not going to use their common fixed costs in this analysis. In other words, we're looking at just the segment and its traceable fixed costs to just that segment. And what this is really showing or representing is going to be the margin that's available after the segment has covered its own costs. If you can't cover the costs, hey, you got to look at that segment and say, should we consider dropping this, right? It's at a loss. In short, right, segment margin is important if you're looking, like imagine you run a business, right? And you say, show me all the segments, right? If one of them is not making money, you might not want to run that, right? So it's a good way of looking at each segment, how it's going to perform now, how it did in the past, and how it might work into the future. Okay, so we aren't going to really belabor this example. It looks like we have a business here, right? So this is kind of like the business as a whole, and it breaks it out between 2 segments or divisions here. So we have a business products division, a consumer's products division, right? So it's like the way it first cuts. These are segment A and B. And then below it, right, in segment B, we kind of have another way it cuts, right? Internal to it, we have like B1, B2. B1A, B1B, right? It's like a segment within a segment. It's like, Inception, right? It's like the dream within the dream within the dream. Now, at an overall level, right, when we're looking at a company in a whole, right, we have a variable costing income statement. Looks like we have $500,000 in sales. Back out the variable expenses, get the contribution margin, back out the fixed, get our net operating income. Okay, so the idea with it here is, and again, I'm not gonna look too much at this because we'll look at it at a problem later on. But the idea over here is we're going to take that total company amount. That'll be the first column, right? So if we go over here, right, we were landing at 13.5. There it is right there, the 13.5. And in the first column, again, because it's total company, we land at 13.5. Right? Then what we would do is we break it out by segments, right? We have like segment A, segment B. We would have a sales minus the variable expenses. And again, what we're really doing here is we're going to back out our traceable fixed expenses, just the A, just the B, right? That will get us our contribution margin, down here. You can see, right, our common fixed expenses, we do not include those at the segment level, right? So this is like a good, simple example here of showing it. If you wanted to go within like the dream within the dream, right, if we then carry down the blue guy here, right, it's like kind of like there's the total for the segment, then we got to break it out between, like B1 and B2, right? And that 81,000, we have to break it out between how much of it is traceable versus how much is a common fixed cost. There, right? Then you can repeat the same process, bring it down, divide it between. So this guy's, just showing it here. You can read that. I mean, I'm not going to sit here and literally read the slide to you. The point of the lecture is to convey the main, topics and ideas. Then we'll kind of get into the nitty-gritty details and the problems. Right, so the idea here is it's saying the online sales segment had a segment margin of $48,000. The retail store had a segment margin of $3,000 loss. Right, so they're going down here. Let's see. So we have the online and then the retail. So they're going all the way to the bottom, right? Online and retail. That guy's a winner. That guy's a loser when we do the segment margin for them, right? So with that. Right, one of the cool things with segment analysis is we can do like a what if analysis, right? In other words, we have this division or segment that's at a loser. What would happen if we dropped it, right? We got rid of it. What would be the outcome of that? So let's just assume, right, if we have an online and a retail component, if that's our business, if we get rid of our retail stores, we'll just assume our online stores are going to increase in sales, right? It's like if you have multiple ways of selling and then you only go to online, your online sales are going to go up, right? So let's just assume that dropping our retail stores are going to cause our online sales to go up by 10%, right? So that's, there are assumptions. So if we were to kind of unpack this, right, our step one here, we'd be saying, hey, if we drop the retail, this is going to cause our company, overall income to go up by $3,000, right? If it was losing $3,000, we get rid of it. We're going to assume that our income goes up by $3,000 by not having it. Then we have to say, all right, now we got rid of it. That's like one side of the coin. Let's look at the other, right? How does the 10% increase in online sales, how is that now going to be going on? So what we're going to do here is assume that it's a traceable fixed cost that remains the same. So we'll assume that our contribution margin remains at 63%, right? 63,000 divided by 100. If sales will increase by 10%, right? So if we formerly had 100,000, it goes up by 10%. We'll have a 10% increase in sales, right? We take that, the increase in sales, by the contribution margin, right? The idea here is our contribution margin will increase by 6,300, right? So in other words, by avoiding getting rid of the retail stores, our income will go up by 3,000. Likewise, our online sales, right, their contribution margin is going to go up by 6,300. Overall, company-wide, right, if we have the 3,000 from getting rid of it, the increase 6,300 from the increased sales there, we're looking at an overall increase of 9,300. Another kind of interesting thing with segment analysis, right, is you can conduct break-even analysis, right? We can look at the company at a whole, or we can look at it in each segment, right? So from a company at a whole, right, we would have our dollar sales to break even. That would be our traceable fixed expenses plus our common fixed expenses over our contribution margin ratio, right? We're at 475,000 there. And again, where are they getting this from? This slide right here, that's where they're getting the numbers to plug in, right? That's from the company as a whole. If we were to look at two divisions, right, like the product division and the business division, the red and blue, it would be, in that case, your break even in sales dollars is going to be your segment traceable fixed expenses. There aren't going to be any common fixed expenses, right? You don't include those at the segment level over your segment specific contribution margin ratio, right? So 90 divided by 0.40, we're at 180, we're at 135. One thing here, right? You may say, wait a minute, right? This guy's at 475. They're saying if we sell 475 in sales, we'll break even from the company as a whole. Why then, if we have two divisions and one sells 180 and one sells 135, we'll break even? That's less than, right? So if you were to do 315, you were to add these two together, both segments combined. Why are they different, right? Like, shouldn't this right here, 475, equal those two divisions? Well, the reason for this, right, it really comes down to this common fixed expenses up here. We're including it at the company-wide level. We're not including it at the segment level, right? So that explains why it's different. Right, so you can look at that there. Feel free to read through it. This is just a summary, right? It's like a high-level overview of it. We will see as we move forward, right? This is just an introduction to these items. We will look at some problems to apply them. So with that, I'm going to end the lecture here. We'll see you in the problems.